Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. US Treasury Secretary Scott Bessent backs a strong dollar as he looks to project a sense of stability around Washington's economic policy. Amazon forecasts fail to deliver. CEO Andy Jassy warns its cloud computing business can't keep up with AI demand, despite plans to invest $100 billion this year. Plus, investors raise bets on more UK rate cuts after the Bank of England downgrades its growth forecast. We'll bring you our interview with Governor Andrew Bailey.
In the meantime, a quick check on these markets. Weakness across the board when we look at the equities picture and the currency picture here. Eurostock 50 futures down marginally by 0.1%, but underperformance right here in the UK. We're looking at a euro dollar at a 103 handle, cable at 124. The countdown to the opening trade starts right now.
First of all, the strong dollar policy is completely intact with President Trump. And I was very happy at his Economic Club of New York speech in August when he reemphasized the importance of maintaining the dollar reserve currency status.
That's, of course, the US Treasury Secretary, Scott Bessent, speaking to Bloomberg yesterday. Is there such a thing as a Trump put? Does that exist? Should we start thinking about that? The whole idea was that Donald Trump would be self-limited in all he did by the fact that he was paying great attention to what the markets priced. Does Scott Bessent represent that Trump put? I.e., he is the market's face of the Trump administration, and all the confusion we've had out of the Trump administration can be smoothed over by somebody who knows how to speak the language of financial markets.
Yeah, well, they send this guy to speak to financial markets, and the closest we got to talking about things that would influence share prices, I suppose, well, that go to your point. He was talking about this being a very pro-business administration, increasing returns, increasing real wages, but there was so much in this conversation, so many different strands for the market to be interested in. There was the line about the strong dollar, which we played there. There were questions around, are other countries manipulating their currencies to get trade advantage? He said we'll have to wait until this review on April 1st, but he did then name-check China as he was answering that question. Fully supports Musk in what he is doing. He tried to add a sense of professionalism and order to some of the things that Musk and his Doge department have been doing. Tried to give gave a different perspective to some of the reporting that's been happening on that subject. So it was a really wide-ranging conversation. And interesting for me on tariffs, he said he's not worried about inflation. He says this is if there were an inflationary impact, it would be a one-time price adjustment, and that's how they're thinking about it.
So inflation at the end of the day is kind of what that sounds like.
Well, no, but he also said he thought that China would take a lot of it.
Right. At the end, consumer. I thought it was interesting. He's also keeping intact the debt issuance plans. We kind of knew that beforehand, but on the campaign trail with Donald Trump, especially before the nomination, he had criticized Janet Yellen for keeping the kind of debt issuance at this trajectory. He's also, and we haven't discussed this yet, talking about or having to defend a president who's talking about getting rid of tax loopholes, who's talking about getting rid of SALT caps as well. I'm still not sure. Carried interest. I'm not sure if that's a positive or a negative for the markets. I haven't quite figured that out yet.
So Trump's the amplitude of Trump is enormous, right?
Yeah.
So it's kind of the swings are huge. He's trying to smooth that out and present a more understandable, less volatile picture of what the administration is ultimately going to do. Which one of those two things do you, if you're in the markets, do you want to deal with? Do I basically say I can ignore the wild swings and ultimately focus on the longer-term picture, which Bessent's trying to paint a picture of? And is that the correct way to tack your way through Trump? I don't know is the honest answer. Everybody thought that Trump would be self-limited by the markets, and I think there's probably some evidence of that already.
Yeah.
But I think that Bessent's going to have to do an ongoing job to keep that on track.
Yeah, I suppose when we're thinking of things that are on the mind of Treasury today, we should just mention it is Jobs Day. We are going to get a jobs report.
Yep.
But the focus might be, I guess, slightly to your point, on the longer-term jobs picture rather than here in the moment. It's always on here in the moment, isn't it, on the jobs number? But it's also on those revisions and whether we saw quite the strength in the labour market last year that we thought we did.
Yeah, absolutely. And how much of this kind of economic resilience, I think we saw Tom talking about at the last hour, really sticks even in the face of these inflationary inflationary concerns, which brings us right nicely to the Amazon earnings that we got on two different fronts. And we had a big debate about this off the program, about what a kind of company Amazon actually is. An e-commerce company? Is it a tech company? What do we pay attention to more? We know they're dealing with the de minimis stuff, but the AWS headlines really took the cake out of Amazon. They're disappointing in the same way that Microsoft and Google did, all by saying the demand's there. We're ready to harp on it. We just don't have the capacity to do it. The data centers, we don't have the technology, we don't have the chips. And that's not exactly a positive thing for this AI momentum trade.
We also don't have the electricity. Yes, but no. I.e., demand is... If you're in a business where demand continues to outstrip supply, right, that's got to be good for your business. I appreciate that you could probably do better, but it does mean that maybe there's more longevity in the trade.
Well, but to Chrissy's point, it's interesting that, yes, this is a nice problem to have, but at the same time, the market doesn't treat it that way, does it? The market prices as if you can deliver everything, well...
Sure.
You know, deliver more. And so the stock sells off when you say things like, I can't live up to demand. But that's kind of crazy because, yes, it is a nice problem to have, that you can't live up to the demand.
So where does this ultimately go? Do they have to spend even more money? And then that raises the question of, is every dollar invested into this capacity ultimately going to deliver a decent rate of return? And this is where I think the market can't run that calculation and really struggles to figure out what's going to happen next.
But what I think is tricky here is there's still two different actual technical products, right? There's the cloud business, which they've already kind of been amplifying. It's not fully adopted yet. There's only like 40 or 50% adoption throughout the whole world. So that's the part that's doing. At the same time, they're running the AI train, and they're trying to merge the two, basically. But you can't adopt cloud with as much fervor as maybe you did in the past couple of years because they don't have the AI offering. It feels like that's the argument that they're making, but what I don't understand is why you can't just have the cloud offering and the cloud adoption without the AI while the AI catches up.
Yeah, well, that's what they've been, and that's what they've been doing in the past, isn't it? The same conversation at SAP and others. So there's a lot to talk about there, and we didn't even mention retail. Apparently, it was a strong retail, holiday season, but nobody seems to care about that.
We'll talk about Temu and all that stuff as well, and the Minimis stuff a little bit later on. Andrew Fels is going to join us on that subject. Let's talk a little bit about the Bank of England. So you were in the chair when it all kind of starts kicking off. Cathy Mann votes for a 50 basis point cut.
And I thought it was a mistake. I thought it was an error. I thought, oh, my goodness, we're going to have to send a headline correct. Surely Catherine Mann didn't vote for a 50 basis point cut, but obviously I should have much more confidence in my colleagues. They were entirely right, and she did.
So the market then prices massively off that.
Yes.
And
that's the only story that mattered, it seemed.
So it takes it as hugely dovish, despite the fact that the forecasts are hugely hugely hawkish. Okay. So the forecasts really growth down, inflation up. That is not a great picture. But everybody focuses on Cathy Mann. So I talked to the governor yesterday afternoon. He's like, yeah, the vote signal is not a communication tool. You read the minutes, ignore this. Well, don't ignore it, but read the minutes. It is not the signal that the market is basically taking on board from this. So if you take him at his word, okay, so you back Cathy Mann out, then the signal you're left with is a really hawkish one.
Yeah.
But that's not where the market is yet. So I wonder how long it's going to take for, and I think we need to hear from Dave Ramsden. I think we need to hear from Cathy Mann fairly soon as well. I think the market is really confused. But net, if you back out the vote split, the Bank of England sounded hawkish yesterday. How long is it going to take the market to kind of balance the scales into a position which actually maybe better reflect the true situation? Yeah,
there was this interesting change in language, which, to your point, was a bit hawkish, careful and deliberate. Gradual and careful.
New word is careful.
Yes, exactly. And they were very deliberate about all of that. But it did make me wonder, Chrissy, whether the market is really concerned about inflation. Because if they were, I feel like they would have responded differently to Catherine Mann going from a hawk to a dove.
Yeah, well, she had kind of warned before this in a previous policy speech, hasn't she? She'd said that she would have this kind of more flexible approach if she saw these signs of inflation persisting. What exactly is she responding to within the data set that's maybe new this time around?
Yeah, well, we have to let her speak for herself, was the words exactly of Andrew Bailey when asked these kind of questions.
I think we basically need to hear from her. But I think that the takeaway is don't put such a great weight on the vote split. And I think, so we talked to him about that, and I think the market did correct a little bit after we talked to him and those comments came out. Let's talk about what else we've got coming up on the show. We've got some great guests lined up. Christel Rendu de Lint is Vontobel's co-CEO, joining us very shortly. Carsten Eggeris is Danske Bank's CEO. We've got broadcast exclusives on both of those two conversations. Danske Bank's numbers have just dropped I haven't read them in as much detail as I probably should yet, but they look pretty good at first blush. In terms of the markets, Altav Kasim, State Street Global Advisors, is going to be joining us, and Nadia Grant's BNP Paribas Asset Management, talking about what is happening with the bigger picture as well. We've also got Mateus Debo, Goldman Sachs Private Wealth Management, joining us a little bit later on in the show. So some great guests lined up this Friday.
Great guests and plenty of data, actually. I mean, it is Friday. We're all excited for the weekend, but there's still some stuff to pay attention to in the next 24 hours. We'll start with 12 p.m. UK time. We get the ECB R-Star report, widely anticipated by these markets as well. And then just 15 minutes later, UK time, the BOE chief economist Hugh Pill is going to be speaking at the National MPC Agency briefing. The U.S. jobs report as well around the same time, about 1 p.m. UK time. As Anna was mentioning, we're going to keep an eye on any of sort of those inflationary read-throughs as well. And then the Fed hawk, Michelle Bowman, also speaking on banking regulation and the U.S. economy, plus, of course, that UMich consumer sentiment data at about 3 p.m. UK time.
It's going to be fascinating to hear what the U.S. consumer feels about inflation in the Trump era and how the Trump era has maybe shifted those numbers. What else do you need to know this Friday morning? President Trump has authorized sanctions on International Criminal Court officials who investigate the United States and its allies. The order would deny visas and block access to the funds of the ICC employees and their family members who assist in US-related probes. The move comes in response to the court's issuance of arrest warrants against the Israeli Prime Minister Benjamin Netanyahu and the nation's former defense minister. Keep an eye on Renault at the Open. This after reports that Honhai's chairman has suggested that his company talked to the French firm about a share sale of its stake in Nissan. The news comes after efforts to combine Honda and Nissan. Nissan's struggling to get that deal across the line. Basically, that deal looks like it's going to fall apart. Nissan shares are up sharply on this report surrounding Honhai, though. It's also probably worth keeping an eye on Porsche this morning as well, after the company sharply downgraded its 2025 outlook ahead of earnings, which are going to come on March the 12th. Is it going to have to say something before then, I think is the key question. And all of this auto news comes ahead of BYD's big autopilot update, which is scheduled for Monday. The Chinese car company's stock is up over 20% this week in Hong Kong, as anticipation builds. And L'Oreal's ADRs fell overnight after the company's latest numbers fell short of estimates. The beauty brand saying demand in the US failed to compensate for continued weakness in China. L'Oreal and the wider industry have been suffering from a deep slowdown in China, where consumer confidence continues to falter. That said, L'Oreal's results were more resilient than those of Estee Lauder, which earlier this week announced plans to cut up to 7,000 jobs due to expected underperformance in Asia. Yeah, it's interesting to see that it's not just the luxury companies. Like the cosmetics business continues to suffer in China as well. It's a really mixed picture coming out of China. You compare and contrast what is happening with BYD, a company that is absolutely flying. The auto sector there looking really interesting, really big technological breakthroughs. And you've also got a signal coming out of the AI story with DeepSeek, which is really propelling Chinese stocks this week. So Chinese stocks have had a really kind of interesting week, despite this kind of really bleak backdrop, which a lot of European companies and US companies are sort of pointing to.
Yeah, we're sort of geared to, Europe's sort of geared to the consumer, maybe at least in this sector, geared to the consumer experience rather than the tech experience out of China. And yes, the China story out of L'Oreal, talking about the youth unemployment level, which is something that a lot of businesses, especially a beauty business, would of course be focused on. But it's not just there. Estee Lauder talking about travel in Asia, and that seems to be something that's weighing on them, and that's been weighing on some of the drinks makers as well.
Yeah, we'll see if how much of that is priced in. People keep using that term, priced in, when it comes to tariff risk or the China risk. And we still see volatility every single day in some of these stocks. So is it really priced in, or is there still a little bit of reaction? I want to flag another earnings story that crossed the wire this morning. That's from Banco Sabadell. We know they're in the midst of a big takeover battle with BBVA at the moment. They came in with strong earnings, and I think a big theme we've talked about on the show has been the idea of buybacks and consolidation with so much money on these balance sheets. Banco Sabadell using those buybacks as a way to entice some of their shareholders to vote against the BBVA deal. I thought that was a really interesting way of using some of those funds.
Yeah, it's quite a classic defense tactic, isn't it? You know, you reward the shareholders more, and so they look more favourably on what that management team can deliver.
Yes. Is it going to compensate? Is it going to be enough? This deal it's the sort of just mechanically it feels really difficult to get done. How easy is it going to be to knock it off course, I think, is the question.
I mean, this is really a game of scale. If you are a bigger player, you have the advantage here. This is where BBVA, you can apply this to the Italian banks, you can apply this to the German banks. If you were the bigger player, you have the advantage, and buybacks seem to be the way that maybe the smaller players can get a little bit of a lead.
Let's talk about where corporate news meets markets. Coming up, European companies are struggling to access proper funding to grow as many take their listings across the Atlantic. Ties a little into the banking story, perhaps. That's the subject of our big take today. We'll get some analysis there. Plus, Saab beats estimates but warns of an unusually uncertain geopolitical future. We'll check on this stock at the open and look ahead to next week's Munich security conference. We saw some of those defence stocks getting a bit of a boost the middle of yesterday as a result of expectation around a Ukraine plan for next week at the Munich Security Conference. Up next, we'll get back to Scott Bessent. The US Treasury Secretary backs a strong dollar and says the Trump administration will not interfere with monetary policy. We'll discuss that next. If you want to get involved in any of these conversations, IB plus BBTV Go, that is the function to use, whether you are in Washington, here in London or elsewhere. This is Bloomberg.
I did an away game over at the Fed. We had a very nice breakfast. Chair Powell and I don't know each other well, so it was very constructive. Everything I'm going to talk about is things Fed done in the past. Prospectively, monetary policy I will not comment on, and I'm sure he's going to do the right thing, so there'll be no criticism.
The US Treasury Secretary, Scott Bessent, speaking to Bloomberg, saying all the things you would hope that a Treasury Secretary would say. I'm not going to mess with the Fed. It's all good. We've got that one under control. We're going to see eye to eye. The relationship's going to be a good one. He will not criticise Fed Chair Jerome Powell. I have to say, even Donald Trump recently has maybe sounded a little bit more on that page as well, which is interesting, which kind of takes you to the question of, is there a Trump put? Does Trump, how kind of contained is he going to be by market behaviour? Altab Kassam, EMEA Head of Investment Strategy and Research at State Street Global Advisors, joining us around the table this morning. We all read your notes overnight, which talked about a series of kind of grey swans, which could emerge over the next year, which markets need to pay attention to. They may be tail risks, but they need to be thought about. In the Trump era, is there such a thing as a grey swan, or is the middle of the distribution of outcomes really fat and there are no tails? Basically, anything is and everything is possible.
Yeah, it does feel like, and good morning, so it does feel like anything's up for grabs. So he says one thing, he does another, he backtracks, there's retaliation. So it feels like you say, the arena of possibilities is getting wider and wider. So
volatility is something that we should rely on. How contained, though, do you think the Trump policy package is going to be by the markets? Do we, as I look at what he's saying, can I go, I can ignore that? Because if you do that, there's going to be a massive market reaction, and as a result of which he's going to kind of pull back on it. He's not going to go too far. Anything that encourages a big negative market reaction ultimately can be taken off the table because Donald Trump will not accept the S&P going lower.
Yeah. So he seems to measure his success by the performance of the S&P. But the market seems to be looking through that. So the market seems to be discounting all his pronouncements as he's just posturing, it's just a negotiation tactic, he won't really do that. So there's a bit of circularity there because he needs to have some teeth. The market, he needs to feel like people are taking him seriously. So there is the chance that he oversteps or he comes up with something that the market hasn't anticipated. So there are still going to be risks out there, even though at the moment market pricing seems to be that he's not going to do it. It's just negotiation.
Yeah, interesting. So we think about the S&P as something he watches closely, but then from that Bessent interview yesterday, also the 10-year yield, maybe he's got, one eye on that and keeping that under control. He, very specific on the thing he's watching there. Let me ask you about, you've given some thoughts to the year ahead and some of the so-called grey swans, so low likelihood but high impact things that could happen. And what struck me, Altaf, as reading these is that some of them, even perhaps since you wrote them, maybe have become a little more discussed and maybe even a bit more consensus. I mean, what are your thoughts on Europe right now, given that next week we're going to hear the Trump administration's thoughts on Ukraine and the potential for, carving out some kind of peace agreement there?
Yeah, well, one of his kind of sort of campaign promises was that he would bring peace to the Middle East and peace to the Russia-Ukraine war. Peace in the Middle East happened. He tried to take credit for it. Peace in the Russia-Ukraine war feels like it's the next thing on the table, and it would be a massive game changer for Europe. I think in return, what he's going to expect from Europe is they're going to buy more US energy, and there's always a negotiation there. And I think Europe would be happy to give up, perhaps cheaper energy from elsewhere for the certainty of stronger relations with the US.
Right, so that's the trade-off. It's the Ukraine story and buying more gas from the United States and perhaps buying more defence product from the United States, because that's obviously something that the US administration could link quite clearly.
Yeah, so buying more defence products is, again, another thing, as you say, which the US could draw a very kind of
Is this all
direct
Europe positive,
line.
I suppose, as I'm trying to get... Does it add up to a reason to buy Europe yet?
Not yet, but given that sequence of events...
The market's buying Europe. The Dax is up by nearly 10% so far this year. When do you buy Europe? That trade's on.
Yeah, I guess there's a distinction, and to be frank, we haven't made that connection strongly enough.
Yeah.
There's a difference between the European economy and the European equity market, and the DAX is up because certain names are strongly exposed to kind of trends that are working at the moment. What we're trying to say is that we believe that there could be a brighter future for the European economy if this starts to kind of play out.
How much of that brightness is dependent on just the spending ability? You write in your notes here that we're seeing echoes of the 1920s and the 1970s. Well, the solution to both of that in the 30s and the 80s was a lot of defense spending. Is that what we're waiting for the bull case?
I think spending generally is what we're waiting for, and clearly Germany holds the key for Europe, and the idea that we could have a political resolution in Germany, they could relax the fiscal kind of debt brake, they could start to spend, which is what Europe's been begging for years. So I think, in a sense, spending is the key, not necessarily just defence, but spending.
Well, you talk about relaxing the debt brake. I mean, we talk so much about it from the equity perspective. What is the trade around relaxing the debt brake? What does that do to the bond market, to the bond market, I should say, in terms of issuance, in terms of volatility? What does that look like?
I think it would obviously increase issuance, but at the same time, I think that's something that the market could readily absorb, and they're quite hungry for that high-quality paper that could be coming from Germany. So I don't think it would be an outright negative for the bond market in Germany or in the Eurozone in general, but at the same time, I think the growth implications would be more positive and definitely more positive for the equity.
The bit we can't figure out is, is this the 20s or is this the 70s? Is this the Roaring 20s? And that sounded like fun. Or is it the 1970s?
I was about to ask you what it was like.
What, the 20s? The 20s?
Not that old. 70s, yes. 20s, no. But the 70s was stagflation and oil shocks, and you could see both of those two things happening.
Yeah.
In so many ways.
Which one?
I mean, we've definitely hedged, but for me, it's more likely to be the 20s, and maybe that's because I remember the 70s and I don't want to go back there, but I think we're more likely to get a kind of consumption-led kind of outcome, which will be positive, at least for equity markets.
I don't really remember the 70s. I do a bit, but I don't remember the 20s. But I know that 1929 didn't end so well.
Yeah.
So is that what we think?
The problem is that...
Let's hope the parallels end there.
People tend to extrapolate, go too far, and then that's what we've got to stop the market doing. That's what happened, in the GFC. So there is always the chance that this consumption-led boom ends in a bubble and a bust, and that's what we've got to look out for.
I'm putting you on the spot very quickly, 10 seconds. You said you're hedged. Hedged how?
I think, gold has been a classic investment for a lot of our investors. Volatility hasn't picked up that much, so there's always the option for derivatives as well.
All right, something we've got our eye on. Altaf Kassam, EMEA Head of Investment Strategy and Research over at State Street Global Advisors, joining us around the table this morning. We thank you so much. Coming up on the program, net income from Vontobel meets estimates. We're going to be speaking exclusively to the co-CEO of the investment firm. That conversation next. Stick with us. This is Bloomberg. Minutes away from the start of the opening trade. Futures looking a little bit downside when we're talking about risk sentiment here. Not by a massive margin, though. We're looking at your Stoxx 50 futures down about 0.2%. The CAC 40 down about 0.1%. S&P futures, I'm just going to call it, they're flat at the moment. We'll see if that changes. Maybe a little bit of that Friday feeling showing up in the equities picture. Then a quick check on the bond market as well. Over in the States, we're looking at a 4.44 on that 10-year yield. Early trades across Europe in the bond market look fairly flat, though, Anna.
OK, those are the markets. Let's get gritty to our next conversation. The Swiss wealth manager, Vontobel, has reported net income for the full year, which has pretty much come in line with estimates. The co-CEO and head of investments, Christel Wandu-de-Lint, joins us now for an exclusive conversation. Christel, very nice to have you with us. Let me start with a question about the business and the scale of the business. So we've got the numbers this morning. Profit before tax increased. Net seemed to come in line with estimates. This is a business, though, that maybe scale matters, or maybe you take a different view. You're not the biggest player, perhaps, in this market, in your home market. How does that influence your ability to compete?
Well, obviously, a very strong set of results, right? Profitability before tax up 32%. It's actually our second best result historically. So speaks to the strength of our business model and the confidence that we have, to answer your question, in our business model. We've grown in our two complementary client segment, institutional clients and private clients. We maintain rock-solid balance sheets. We're able to pay out a strong dividend. We're proposing 3 Swiss francs to the General Assembly, which would be 64% payout ratio. And I'd like to also speak about, the confidence of the future of this company with the 2 defining acquisitions that we've made last year as well.
Yes, and one of those, you took a stake in a London infrastructure manager, which gives you more exposure to private markets. I wonder how big you think private markets can get for you, Christel.
Well, this is a strategic entry into private markets. The various steps that we're taking, offering to our private client through third-party provider and having selection capabilities, expanding our own offering with our very own boutique, and indeed acquiring skill, just like we did with Ancala. We'll go, as fast as we can, but not faster than necessary, and we think that is going to be a significant area for us.
Christel, good morning. It's Guy. Are you going to continue to consolidate? Is this the model now? How much more can you do? Are there ongoing conversations right now? How alive is the consolidation story?
Well, look, Vontobel's strategy is very clear. We grow organically and inorganically. And when we grow inorganically, we really have 2 key points in our mind. Number 1 is to add scale in our core markets, and that is more for the private client side. And that's exactly what we did with the EHAG acquisition book last year. Yep. And we want to remain future-proof and add capabilities and skills, and that's exactly what we've done with Ancala. So it's not about a target or a number or a timing. Yep. It's about a strategic fit, and we will continue on that strategy.
Okay, Is inorganic growth a priority? How much of a priority is it? How much time do you spend thinking about that route to grow? In terms of your day, how often are you talking about this? How many conversations do you have? I'm just trying to get a sense of how active this conversation is at the moment.
Well, we've done 2 acquisitions last year, so you can imagine that the conversations were pretty active. It also means we didn't look at only two potential candidates, right? So there are active decisions, but again, it is not an end of itself or in itself. It's not like we wake up and say, let's go on a buying spree today. It is about where does it fit? Do we want to add scale? Do we need to add scale? Do we need to add capabilities? And are we finding the right strategic fit? These are the conversations that we're having, and this is exactly how we approach inorganic growth.
Christel, it's Creedy in London. Can you talk to us a little bit about maybe that appetite for growth, that appetite for scale, in the context of some of the geopolitical volatility that we've seen? Some of your peers might say this is not the time to grow, to scale, especially in the light of tariff debate and maybe deglobalization. How are you and your clients thinking about that?
Well, our clients are observing, right? This is probably a time of a little bit of wait and see where the dust settled. Now, I would say Vontobel has been around for 100 years. We celebrated 100 years last year. I personally shouldn't say, but I've been in market for 30 years. You do have political, geopolitical, as well as economic cycle. And the job is to go through strategically and have a direction that you're sticking to, but adapt if there are major changes. So that's exactly how we're thinking about the current situation and our outlook.
Well, Christelle, what does that adaptation look like? What kind of scenario planning are you doing, given that there are so many? I mean, I'm sure these are the conversations happening in your boardrooms.
Yes, absolutely. I mean, look, with scenario planning, you have to plan for less growth, more inflation, etc. But the business, the core of the business model, we see it future-proof. We're confident about it. What are we working on as well is obviously efficiency, AI, this type of technology, smart technologies. And if there's a major shift geopolitically that should have an impact on the business, then we'll tend to it.
Can I ask you about your expectations, Christelle, about the way that regulation and regulatory impulses change under a Trump administration? Clearly, that's the US, for the US to solve, but these things have a habit of rippling across the Atlantic. Do you anticipate that financial services broadly will be more loosely regulated in a Trump administration?
Well, I think the jury is still very much out on this one. This is certainly something that can have a big impact, in particular on the relative competitiveness of zones. Look, we, Vontobel, will not be defining the regulation. We are really on the receiving end. But one is to hope that the regulators will also have a look at what's happening across our borders. But for now, the jury is indeed still out. It's for the US administration to decide which way they will be going, and for the other region to take stock.
Christelle, final quick question. What are your clients doing? How are they feeling? Are they risk on? Are they risk off? Are they buying gold? Are they buying stocks? What kind of sense do you get from the conversations with your clients right now about their level of risk appetite?
So very interesting. I mean, for 2 years, the clients were really in wait-and-see mode. The risk appetite has come back. It started as we expected for the active side within fixed income. In fixed income, that's where we capture the flows. That's what we were expecting. What I find particularly interesting is we're seeing the first signs of investors looking at emerging markets again, and kind of as expected is starting from the fixed income angle. And that, to me, is kind of a little spark that caught my eyes, definitely. OK. We'll pay attention to that spark, see if it grows into something more of a flame. Christelle Rendu-de-Lint, thank you very much indeed, co-CEO and head of investments, joining us at Vontobel. What have we got coming up for you? We're going to take a look at the stocks to watch. There are lots out there this morning you want to pay attention to. L'Oreal is certainly one of them. The sales missing estimates. Weak China demand is the story there. Keep an eye on Porsche. Keep an eye on what is happening with the AI trade this morning. We have lots to focus on. That's all next. This is Bloomberg. We are 18 minutes until the opening trade here in Europe. There's not a lot of signal in the market numbers this morning in terms of where we're going to go. There's a lot to get through today. Of course, there's the payrolls, there's the revisions, there's UMISH. We've all got to factor that into our thinking as the day progresses, plus there's the Trump story, which we need to fold in as well. So that's kind of where we are in terms of the setup. Loads of single stocks that are worth paying attention to, though, today. So we'll come on to that in just a moment. The Bank of England has warned that inflation will rise sharply this year and has downgraded UK growth forecast. That sounds not good. The bank cut rates by another 25 basis points, with 2 members of the MPC voting for a bumper cut. I spoke yesterday to the governor, Andrew Bailey, after the decision, and asked him about kind of how the MPC is thinking about the cadence, the timing around future cuts.
The way I would interpret it is this. The sort of the set of things that we are going to have to judge every time we meet has just got more complicated, frankly.
Does that make it harder to make a decision to cut rates? Because, as you say, it's symmetrical. You don't know whether it's going to be inflationary or deflationary.
It's going to give us a lot more to think about every time, and we're going to have to be careful in the way we do it. But it's meant to say, look, there is more uncertainty. Don't take from that a particular directional message, other than I still think the path is down.
Yep.
But the world is more uncertain.
Are you still trying to get to 100 basis points worth of cuts this year?
Well, I've never been trying to get to a number, actually. I mean, I'm trying to get inflation sustainably to target. That's my job.
Right.
whatever path of interest rates does it will be the one.
Can you understand why the vote split looks dovish?
I can, but I would always caution you not to put much emphasis.
So it's not a communication tool?
It's not a communication tool. And the reason it's not a communication, we do not sit down and say, what do we want the vote split to be this time? Each member votes their own position. I don't know going in what the vote's going to be in that sense. The reason, and I would say there's no groupthink on the MPC. People vote their own position. You can, and I would encourage the market to read the minutes pretty carefully this time, because you will see a series of positions set out in the voting.
Bank of England Governor Andrew Bailey speaking to me yesterday. Lizzie joins us around the table to talk about this. Cathy Mann is not Dave Ramsden, okay? Is kind of the way I think we should frame this.
I told you that in the LIX.
She's an outsider. I know. I'm trying to set you up here so you can go down this road. So, do I ignore Cathy Mann? And because yesterday we discussed this, you couldn't. And I'm wondering, therefore, what the true story is that we should take away from yesterday's A, vote split, B, Cathy Mann voting for 50, and C, what looks like a quite hawkish set of forecasts.
Yeah, I mean, the fact was it was read dovishly at first because it was such a shocker initially that Catherine Mann would switch like this. She is an activist, though, so maybe it's not that shocking. She's gone from all the way over there to all the way over there. It's shocking, OK? Yeah, but
it confused a lot of people yesterday.
It did initially. And for what it's worth, I agree with you that it says a lot more when an internal dissents, an internal member of the Monetary Policy Committee, than an external member like Catherine Mann, OK? But I think what is exciting is that March is live off the back of this. You had that dovish reaction at first to the vote split, then you had the hawkish reaction when people had time to process the forecasts, and it's because inflation is going to take longer to come down.
It's going to take ages to come down, like 2028.
Exactly, that is the problem here, and that's what eventually the market latched onto.
Well, talk to us a little bit about the ECB as well, because it's not just the BOE. We've got a report that we're watching out for today. Put that in context.
Yeah, this is interesting as well because it's nerdy, as you love, Critty. It's all about R-star, the neutral rate, which is the level, of course, that neither stimulates nor constrains the economy. And this is going to give us a big clue as to, hopefully, when the ECB is going to stop cutting rates. But the point is, as we've said before, neutral isn't necessarily terminal, and you've got weakness like this in the euro area economy, maybe they go beyond it. So we really do need to keep an eye on this report today. But some members of the committee saying it shouldn't play too big a role, actually, in the decision-making.
Lizzie, thank you very much. Bloomberg's Lizzie Burden on the Bank of England, the ECB, what we need to watch out for in terms of the R-star communication at the latter. Let's go back to the Bank of England, though, and start a conversation about these markets with Ven Ram from our Markets Live team. Ven, Lizzie talking there about what we heard from the Bank of England. Let's get a gilt market view here, because the gilt markets, responded to the vote split initially. By the end of the day, we did see gilt yields up a little bit, as if they were more alarmed, perhaps, by what we'd heard on inflation and the inflation forecast. Put it all together for us, your view on gilts after this Bank of England meeting.
Morning, Anna. It was a terribly interesting meeting from the Bank of England. The key to getting a grip on the BOE's messaging, though, was to look beyond that dissent vote. I think what confused a lot of traders was that dissent vote from a very hawkish member, Catherine Mann. So I think that's what confused the markets. But if you strip out the dissent vote, you really see barely anything in that report that could be construed even as mildly dovish. The BOE revised its growth forecasts lower for this year, and they revised up the inflation forecast for the forecast horizon, and they think that inflation is going to be 3.8% at the peak this year. So if your inflation is going to bob around 3.8%, your benchmark rate can't really go below 4%, I beg your pardon. So if the markets are thinking, the rate is at 450 now, if the markets are thinking that we are going to get 3 rate cuts, they are smoking something that they shouldn't be smoking. We are not going to get more than 2 rate cuts. And March is not alive on the table, as was mentioned earlier. It's going to be May. The next earliest May rate cut we are going to get is in May. So I think the BOE introduced additional language yesterday saying they're going to be careful. And if you strip beyond the dissent vote, you will see why it is that they introduced that word careful.
There was also a lot of talk about productivity yesterday, Ven, and the fact that basically the UK doesn't have any, or certainly no productivity growth. If you extend that thought, you end up with the conclusion that if the UK, if the bank cuts, it's going to stimulate growth, and if there's no productivity growth, that growth is going to be inflationary. So the Bank of England presumably can't cut very much until productivity picks up.
Absolutely, which is why I think that, I think, you're not going to get more than 2 rate cuts at the max, because, if your inflation is going to be sticky as it is, and if you look at the 2-year inflation break-even rate guy, that's really got the message for you, real central message from the markets. Before Reeves presented a budget, it was bobbing around 3%. It's now bobbing closer to 4%. So I think that the markets are saying that, look, you've got a mighty inflation problem here with all that spending and borrowing that you've outlined in the budget. So how are you going to square that circle is what the markets are asking the BOE. And the BOE, for one, are saying that, look, we are not going to be able to square that circle. Let's face it, we are going to be careful. We are going to be cautious in cutting rates further, which is why I think that we are going to get more likely to see 2 rate cuts from the BOE here rather than 3 rate cuts that the markets are factoring in.
Certainly something we're going to be keeping a very close eye on as we speak. We're seeing cable at 124.41 this morning. Bloomberg's MLI's Ben Rom joining us this morning with that conversation. You get more updated analysis from him and the team. MLIV Go is the function on your terminal. Let's go from the macro to the micro and get our stocks to watch with Joe Easton. Joe.
Morning, Critty. So we could see some weakness in L'Oreal over in France today after the company issued another disappointing update in terms of its quarterly sales. And we saw the ADRs dropping in the US. We saw a slump in those shares and they ended up down around 1.8% in the post-market trading. Now, it would be worth noting that their stock has already come down significantly over the past year, so potentially some of that is already priced in, a 22% drop for the stock on a 12-month basis. But keep an eye on the peers as well, including Beiersdorf, which is the Nivea skincare owner, and also some of the chemicals companies which supply the ingredients that go into cosmetics, particularly Croda, one of those listed in London, could be in focus today. Then in terms of Porsche, it's another disappointment there as well. The company downgrading its earnings forecast, and analysts today pointed to potentially 25% cuts to their earnings estimates, though potentially this is another stock that's already priced in a lot of the negativity we can see on a 2-year basis that is down sharply. And the take from Jefferies is saying this might actually clear the way for a bit of a rebound, resetting the investment case for the German car maker. That's the take from Jefferies. Philip Houchois, we'll see if that happens, and potentially we might see a bit of a relief, though potentially we are seeing it lower on Tradegate today. Then in terms of Italian banks, we've got yet another deal coming through as BPER launches a bid for Popolare di Sondrio. It's worth around €4 billion, so that one potentially going to be rising. It's around a 5% premium in terms of the price there, but it's another in the swathe of deals that we've seen, with Mediobanca rejecting Monte dei Paschi, Banco BPM, of course, looking at the Anima asset manager, and Unicredit, the one that's been most active, pursuing both BPM and Commerzbank, and then taking that stake in Generali. Lots going on that one, and do keep an eye on a couple of other peers. There's lots of listed Italian banks. I'm watching Intesa Sanpaolo, potentially Fineco Bank as well, could be another one to keep an eye on. Italian banking M&A back in focus this morning.
Certainly something we're keeping a very, very close eye on. Joe Easton, our equities reporter, walking us through some of the stocks to watch at the opening trade. And he mentioned the Italian banks. We know that BlackRock, which has a stake in both Banco BPM and I believe Unicredit as well, has meetings with Giorgia Meloni on the docket. So that's happening in the background of this as well. We should also talk about another banking deal in Spain that is getting quite a bit of attention this morning. Banco Sabadell came out with their earnings. They've announced big buybacks off the back of pretty strong earnings we're seeing across the periphery. And it looks like the buyback story really being used, as Anna, to put in your words earlier, to fight off an activist bid. It's a very normal strategy to do at a time when now, if they do get regulatory approval for this hostile takeover in a couple of weeks' time, Sabadell, shareholders will have to react fairly quickly. And I think they're hoping that this buyback sweetens the deal.
Yeah, absolutely. So a lot of different reasons to do buybacks, of course, but yeah, one of them can be if you're trying to defend yourself and your management team from bid activity. We had an interesting conversation, didn't we, about the use of buybacks yesterday with DNB from Norway,
yep.
And the CEO there making the point that, not talking about her business, but talking about businesses in general and banks in general, that if the profits aren't good enough, then if you don't know, another reason you might do buybacks is if the shareholders prefer the money back than to let you keep it, and then you might, try and reward those shareholders. So we'll continue to watch that sector and its use of them.
It's interesting because her bank trades on a price to book that's north of well north of one. You can still argue that there's a bunch of banks out there in Europe that are still really cheap.
Yeah.
So you could argue that buying back stock actually may make sense if you really think about it in the long term. But yeah, no, there's been this idea that certainly excess returns have been returned to shareholders. That's driven really quite a strong rally in European banks. So European banks have had a really, really strong run. Better than US banks in some ways.
Yeah, I mean, 20% increases in some of these names in just 5 weeks year to date. That's wild. But it also makes me wonder if there's some sort of unwind that's coming, especially if you do start talking about interest rate cuts from the ECB, from the Bank of England, and beyond.
Yeah, always watching that conversation, of course. Coming up, we will get to the market open. In terms of the futures picture, not a huge, there's not a very consistent picture coming out here. We're pretty flat on some of these markets. You can see the FTSE 100 expected to go a little bit lower at the start of trade. Elsewhere, a little bit of softness seems to be the overall theme. We'll keep an eye on the DAX as well. Might see some resilience there. Coming up then, we'll bring you that market open. This is Bloomberg.
Friday morning, yes, we made it. A Trump week feels like a longer week, doesn't it? There's an awful lot that has happened this week, so I think we're glad that we've made it to Friday. Rally into the European close yesterday. Remember, we were hitting records in European markets yesterday, so we kind of closed out here. US markets were there when we closed, so a little bit of upside, maybe to price in. However, there's a bunch of things overnight which probably maybe detract from that, and you need to back out. Amazon, etc., and you need to think about that. There's a whole bunch of European stories as well, which we need to focus on as well. Porsche, L'Oreal, plenty of stock names, big stock names that are going to be in play this morning here in Europe, Critty.
Absolutely, but you just see those markets end on a positive note in yesterday's session, which might explain maybe some of the negativity today, marginal negativity, I think, in the futures picture. Your Stoxx 50 futures down about 0.2%. The underperformer this morning is the FTSE 100, Anna, right here in the UK, down about 0.4%. Even the CAC Iran, which, by the way, has redeemed all of its losses since the snap election last year, only down about 0.2%.
Yeah, interesting recoup of losses there. Let's talk about some of the individual stocks that could be on the move then, Critty. And we'll start with L'Oreal. It's a company we've talked about already. Fourth quarter sales rising 2.5%. But they missed estimates because of China demand remaining weak, in particular youth unemployment, an area of concern for that kind of business. Not so many youth perhaps buying Porsches, but there's something up with that particular business. Porsche expected to be weak this morning. The car maker slashing its 2025 guidance, and that move called a major concern by one of the brokers, Bernstein, referring to it in that way. A key transition year for that business. And Saab in the defence sector is interesting. They've come out with fourth quarter sales that beat estimates, but bear in mind this whole sector was marked down yesterday on expectations of something to come on Ukrainian peace next week in Munich.
Yep, Munich Security Conference next week. Here we go. Friday session is almost upon us. It is time for the opening trade. Let's show you some numbers. Let's get an idea of what is happening. We are in the midst of earnings, so actually the single stocks matter maybe more than the indexes at the moment. But Europe closing at highs yesterday. We were hitting records yesterday across Europe. The FTSE 100, obviously a factor in that story. The Bank of England, what's happening with the pound, a factor into the FTSE story. So the FTSE 100 out of the gate, a little negative. We're down by 0.1%, but just 0.1%. We're, of course, waiting for payrolls a little bit later on. The IBEX is up a little bit. We're up by 0.1%. The Spanish banking story, as Critty's been mentioning, absolutely critical to that narrative. The CAC is open, but down by 0.1%. At an index level, there's not a lot happening this morning. So let's talk sectors and let's talk about what's happening with some single stocks.
Let's do it. The banking story very much in focus from an index contribution perspective. Danske Bank actually is one of your top index contributors to the upside, followed by BNP. So again, very much in focus when we talk about those moves. To the downside, though, you are seeing a lot of the biotech stocks on the back foot. From a sectoral perspective, it's absolutely showing up. The healthcare sector down by 0.8%, Anna, but gains in the banking stock sector higher by about 0.2%.
Yeah, some fairly sizable moves for these sectors. Construction and materials also doing pretty well. Some of the Scandinavian names doing well on the back of that Vinci over in France, up by 2.5%. So construction and materials seems to be an area of strength in today's session. To the downside, healthcare stocks certainly under pressure, down by 0.8%. There's a mixed bag there. We've got GSK, Sanofi, AstraZeneca, all down by more than 1.5%. So that seems to be a fairly consistent theme, the pharmaceutical sector being weaker this morning.
Renault's the top gainer in the auto sector this morning. It's not up by much. We did see Nissan up circa 8% overnight on the back of the Hon Hai talk, but Renault is up 0.7%, one of only two stocks in the auto sector that is higher. Porsche is open, 911 is open, so we've got that stock down by 1.5%. That's actually not bad compared with some of the earlier calls that we saw. So Porsche is down by 1.5%. In terms of the kind of the broader picture, it's interesting to see what is on the move today. In terms of what we're seeing on the point story, L'Oreal is the second biggest points contributor to the downside. That stock is down by 3.44%.
Yeah, fascinating one, right next to Sanofi as well. So the pharma sector also taking a beating alongside L'Oreal. I just want to take a quick moment and talk about Sabadell, which is also seeing a little bit of a nope, that's wrong. Hold on. We're going to get that numbers coming out because, of course, we do know that Banco Sabadell came out with their earnings this morning. Those shares higher by 1.1%, after they announced their buybacks as well. So we're going to keep an eye on how that stock continues to trade. Let's get a broader perspective, though, and bring in Nadia Grant, head of global equities at BNP Paribas Asset Management. Nadia, pleasure to have you on the program. We thank you so much. Well, we keep kind of talking about what is driving the market trade. Is it ultimately maybe some of the buybacks, the earnings stories that we're seeing in the banking sector, among others? Is it perhaps the tariff concerns, the geopolitics? For you, what's driving the market narrative right now?
Great to be here. I think it's really about the fact that you have a strong fundamental backdrop for equities. So, as you said, you're in the thick of the earnings season. You're halfway through in the U.S. You're in the peak earnings week in the U.S., a third of the way through in Europe. So far, so good. So what we are seeing is that, okay, the market is expecting, or most of the economists are still expecting the U.S. To grow towards trend. And that's a very positive backdrop for earnings growth. So you're still expecting double-digit earnings growth for the full year in the U.S. And so far, what you're hearing and what you've seen in Q4 is not invalidating that, is still very much in line with that. But you have, as you mentioned, the tariff uncertainty, and that obviously could put pressure on that otherwise very robust backdrop for stocks because you're already hearing a lot on the currency become a headwinds for a lot of exporters in the U.S.
Well, the consensus keeps seeming to be that this tariff story is priced in. We've known about it as we saw Donald Trump even increase in some of the polls going into the election. We did see that movement happen in the markets. Is when people say tariffs are priced in or looking to price tariffs in, is it more through the currency market than through the equity market? Is that how you do it in a portfolio?
I don't think the tariff risk is priced in simply because we just do not know. So I think it's about scenario analysis. The market is a discounting mechanism, and right now, when we look at the market as a whole, it seems to discount a pretty sort of short-term shock, a pretty benign outcome. But we simply don't know whether this administration looks at tariffs as a tool for negotiation and for them to be more of a short-term shock, and you can look through it for the equity market. Or whether, on the other hand, it's really a way to rebalance federal budget and raise federal revenues, and then you could have a more meaningful impact in terms of inflationary and growth pressure, and that would have more, obviously, a material impact on your earnings picture.
So you're quite positive on the US growth side, but there are these questions around tariffs then, Nadia. What about the AI CapEx theme? Are you investing in the United States? There's been a lot of focus on that, of course. Are you investing into the AI CapEx theme, or are you a little nervous as a result of DeepSeek and pulling back on that investment theme?
we're very much invested in that sort of secular mega trend. DeepSeek was interesting in that the market initially thought that if you were going to generate a lot more efficiencies, then surely those hyperscalers wouldn't have to invest this much, these hundreds of billions of capex that they've been investing. Actually, it seems as though the cost of their model was not perhaps what it was first said it would be, and more comparable to what we have elsewhere. But more importantly, as you generate efficiencies, it's very positive for the AI themes, and you have this paradox that I had not heard about before, but was all over the news after the DeepSeek, the Jevons paradox, that actually says as you make something more efficiency doesn't mean that you're going to use less of it. Actually, you're going to increase usage, and actually demand for it are going to increase. So we're very much leaning towards that, but acknowledging that there's going to be it's a long upward trend, but there may be a lot of volatility on that capex, and so you may have air pockets, but really the picture of the broadening of the TAM is very constructive.
Are you leaning more into the Mag 7 then as a result? I was looking at some analysis of where we've got to on the earnings story. We've had 6 of the 7 reporting so far. The overall picture, according to Markets Live blog, earnings have been better than expected. Revenue has disappointed, though, a little bit. Are you leaning into Mag 7, or are there other ways to play that?
I like the whole supply chain. I still very much like the semi that are exposed, so those that are actually providing the infrastructure, the GPUs, so very much like that space and those custom ASIC chips. And then we're very selected in terms of which Mag 7 we actually like. But yes, along the supply chain, I think you have great opportunities.
I just need to make a little correction. Porsche is down. My bad. Very hard. I was looking at the holding company. It is down and down really aggressively. It was halted a moment ago. It is paring some of the losses. It's still down by 4% on the back of the warning that's come out. However, Porsche takes me on to my next point, which is the Dankse is having a really good year. European equities are having a really good year. I've converted this into dollars. So the Dankse is up by 10.4% year to date. Okay, the S&P is up by 3.43%. Europe is massively outperforming the United States at the start of 2025. Does it continue?
I can see a scenario where it could. I can see a scenario.
There's a big pause there.
So basically, I think in January we don't have a lot of data, right? So January tends to be a bit of a reversal month. Like, what has our performance?
That's why I'm asking the question, does it continue? Because normally we have this and then it doesn't continue.
Precisely. So my view is that if you just look at the fundamental with the information we have today, meaning that European earnings are going to grow 1%, they grow 1% this quarter, and low single digit for the whole year versus double digit for the S&P. The economic picture is not the same. The earnings picture is not the same.
They're cheap, aren't they? Isn't that the argument? They're cheap.
But you need a catalyst.
Okay.
So, because otherwise you're cheap for a good reason.
Sure.
Right. So if you don't want to be a value trap, you need a catalyst. And I think a catalyst could be a resolution, some ceasefire.
So that could come next week?
That could.
Well, not the ceasefire, but the Trump plan could come next week.
That would be a catalyst. But absent a meaningful catalyst, the backdrop is not as conducive to our performance as it is in the US.
Well, that catalyst suggests that there's an overhang then in the European markets connected to say, the war in Ukraine. Is that fair to say? Or is there only upside change from some sort of solution, some sort of geopolitical solution?
So the way it would manifest itself would be obviously you've had manufacturing repression because of higher oil price in Europe. So you would get a revival, like you'd get the cheaper oil that would really stimulate your manufacturing footprint, and you can really see upside. That would be fundamental upside through earnings for your German manufacturers, for your chemical companies that have been suffering greatly from the conflict because of the impact of the oil price.
Porsche's halted again. We'll come back to that in a moment. Nadia, great to see you. Thank you very much indeed for coming to see us. Nadia Grant, Head of Global Equities, BNP Paribas Asset Management. Let's talk about the Core 6, show you some numbers, give you an idea of what's going on out there. There's a lot of single stocks that you need to be paying attention to. Ferrari's a little soft, which I wonder whether there's a little bit of a Porsche read across. I don't know. I'm not suggesting that is a sort of solid line, but it might be a dotted line that the market's paying attention to this morning. The AI trade appears to be back on, Schneider's back on, but ASML is weakening up a little bit, Novo's up, Farmers mixed this morning. Nestle fairly mixed as well, up by a little bit today, 0.6%. There are a lot of really interesting single stocks out there. Joe Easton, what are you watching?
So one of them really interesting guy is L'Oreal. We are seeing that stock coming down, pretty much matching the move that we saw on the US ADR yesterday. Now remember, as Anna was mentioning, a lot of that is tied to the China trading. Sales not as strong as expected, particularly among the younger markets, according to the company. But the US not looking great either in terms of the sales and the profit on that one, and we are seeing Beiersdorf coming down very slightly as well. Remember, the maker of Niveus, a little bit of a read across on that one, but L'Oreal definitely the bigger mover, down almost 4% now for that one. Then Porsche, as Guy was mentioning, in and out of a trading halt, but we have got a price on that one, so we're down 3.9% on Porsche at the moment, and there is a bit of a read across coming through into Volkswagen, given the relationship, the connections between the two companies on that one. So Porsche coming off. Remember, analysts saying they could cut their earnings estimates by around a quarter, given those weak numbers out of the company yesterday. So that one definitely a weak spot. Then in terms of those Italian banks, now not so surprising that actually the company getting taken over, Sondrio, that one is the best performing bank in Europe today. So we're up 6.5%. The takeover bid is around €4 billion, coming from banker BPER, and that one is the worst performer. So those stocks go in separate directions, given all that money that they'll have to pay out for the company. But it's the latest in a swathe of Italian banking M&A news that we're struggling to keep track of every day. There seems like there's something new on that. Then in terms of Danske Bank, it's the rates outlet looking really good on that one, and they are distributing a lot of that cash back to shareholders. Kind of the theme that we've seen from the Nordic lenders during this earnings season, once again benefiting from all those rising rates. So looking pretty strong on that one. Then there's a couple of defence-focused stories to focus on. Finally, firstly, Saab coming off the operating profit, missing expectations. Bear in mind, it's one of these defence stocks that's really massively seen their multiple rise over the past couple of years, given the conflicts that we've seen. So it is only coming off a massive high. And Iveco, now this is the truck maker, the lorry maker that you see these lorries all over the street, but they've also got a part of their business that sells 4x4s to the military, and they are saying today that they're going to spin that business out, potentially separate it, and that is a surprise to the market. That's why that stock over in Italy rallying. It's the best performer on the Stoxx 600. Iveco looking to spin out their defence business, according to a statement from the company. That one doing very well over on the Italian exchange this morning.
Thank you, Joe. Joe Easton with a rundown of some of those movers. L&G is also a mover in the UK financial services space. That stock up by 7.8% this morning, selling its US insurance entity to Meiji Yasuda. They'll get a cash consideration for this of $2.3 billion, we understand, and that basically means they can return more cash to shareholders. So there's that theme again. So they're going to be able to do an additional share buyback of £1 billion as a result of this, and the stock goes higher.
52-week high for Legal & General, 52-week high pretty much for the whole of the insurance space this morning, so they're all doing really well. A whole bunch of 52-week highs being hit. The banking sector's hitting a whole bunch of 52-week highs as well. AIB, Banco BPM, Banco Popular, Caixa, Commerzbank, Danske, Fineco Bank, SocGen, Intesa. The list goes on. They're all. The banking sector is by far and away the best performing sector year to date. And this morning, again, there are multiple 52-week highs within that space.
One of the criticisms in the U.S. when this happens, when it's a buybacks-driven market, is that the fundamentals are void of it. But if you do start to see some of these consolidation bets actually come through at the same time that these buybacks are happening, that's where, to our previous guest's point, that's where the value creation actually happens. But then, isn't that where the biggest concern is, that those consolidation bets won't, at the end of the day, come through? So is there some sort of maybe pullback?
Yes,
in the cards?
We can certainly talk about consolidation later this hour. We'll talk about the Danish banking sector, expand that to Europe perhaps a little as well, but consolidation relevant in both of those geographies. Coming up, let's talk about some of the things that are going on at Amazon. It's stuck between AI capacity constraints and trade policy concerns. The stock fell in after hours. We'll dig into the details there. This is Bloomberg.
AI represents for sure the biggest opportunity since cloud, and probably the biggest technology shift and opportunity in business since the internet. And so I think that both our business, our customers, and shareholders will be happy medium to long term that we're pursuing the capital opportunity and the business opportunity in AI.
Amazon's CEO Andy Jassy talking about the AI outlook for the business. Amazon shares fell in late trade. The weak outlook in its latest results, a factor there. The e-commerce giant warning investors that it could face capacity constraints in its cloud computing division. E-commerce, that's part of it. We'll come on to that part of it in just a moment. It is going to invest $100 billion this year in AI. Still says it's basically it's chip constrained, it's electron constrained, electricity constrained. Matt Broxham from Bloomberg Intelligence joins us now. Matt, Jassy's talking about the big investment, but he's talking about the returns being lumpy, and Amazon's always tricky to figure out. But how do I understand how efficient this investment is if the returns are going to be lumpy and all over the place? Is it easy to understand what the glide path looks like for Amazon?
No, it isn't. I guess that's why you've seen such volatility in all these big tech stocks this earnings round, because investors have got used to beat and raise every quarter, driven by cloud. And to this point, AI has been underpinning that too. And I mean, Amazon's cloud business is still growing very strongly, 19% year on year, but that's stabilised. And they're pointing to these kind of short-term supply constraints. So I think, the $100 billion they're going to spend mainly on AI it is a big question mark. I think clearly from what Andy Jassy was saying on the conference call yesterday, he's a passionate believer in the mid to long-term opportunity that AI represents. Basically, every piece of computing technology is going to go under some kind of AI transformation, and over the long term, that's going to play out into a business that's way, way bigger than they've got today.
Talk to us about the different products that we're seeing these big tech names provide, or the similarities between them, because we've got used to companies that provide cloud also then talking about providing AI to their customers. So put it in the context of Microsoft and Google. Is this the same or different?
It's there are overlaps, but I think AWS are describing themselves. They want to be the AI supermarket, so they'll do essentially everything. So they talk about it in a kind of three-layer stack. So at the bottom, you've got the chips, and Amazon's saying you can either take our proprietary chips or NVIDIA, whatever you want, Mr. Customer, we can give it to you. If you want some models on top of that, large language models, then here we go. We've got everything for you, and they've even got DeepSeek on their platform now. If you're really not that tech savvy as a company and you want the whole thing, we've got agents that sit on top. You can take our agent, somebody else's agent, so it's that complete suite of everything possible you could want. And whereas the other companies are kind of focusing more on particular parts of that stack. So I think that you're kind of there for everything from the smallest company to the biggest corporate and in between.
OK, stay with us, Matt, because so far we have not talked about anything that's a parcel that arrives at your door, and that's another part of the Amazon business that we've known for many years. So we don't want to neglect it entirely. And that thought takes us on to something that is affecting or could affect a number of retailers in the United States, certainly, Critty, and that's the change in the de minimis rules that we've seen coming through from the new US administration. Remind us what those are and what impact that's going to have.
Yeah, absolutely. So the de minimis rule in the United States basically is a loophole for shipping companies like Amazon that have a massive foothold in the likes of China that are actively importing some of those goods into the United States, except you don't have to pay the customs duties, the tariffs attached to it. If it's below, get this, $800 until now, where Donald Trump has revoked that loophole. But just for some global context, these are some of the levels in dollars, by the way. We've currency converted these for some of the other countries around the world. The United Kingdom at $167, the European Union at about $154. Japan's the approximate number, about $60. Even Canada, that says zero, but it's actually supposed to be $15 when you convert it, of course, to American dollars. It speaks to this idea that this is a loophole that really brings that America first kind of theme to the forefront. It also affects the likes of Shein and Temu, and that was really the focus around this executive order. But like you said, Anna, it's very much affecting Amazon as well. Experts, however, saying that this may just mean that some of these companies can't actually just redirect, and ultimately the consumers are going to have to pay for it.
OK, let's join a few of the dots here then, because we've talked about Amazon, and this clearly, the change in the de minimis rules in the US could have an impact there, but it will certainly have an impact on some of the Chinese retailers that have got a foothold at the lower price point range in the United States and here in Europe. So let's talk about Chinese fast fashion retailers. Shein and Temu have been slapped with a 30% levy on US-bound goods, or that's the effect of this change change in the de minimis rules. Let's bring in Andrea Felsted, who joins us from Bloomberg Opinion, to give us thoughts on this particular sector. So if we see this change in the de minimis rules in the United States, and as Kriti pointed out, they're quite, the rules were really generous to companies like Shein and Temu previously in the US. So, does this completely undermine the business models of companies like Shein?
It doesn't completely undermine it. It's going to make it a lot more difficult. And they have been trying to diversify supply, but this is undoubtedly part of their business model. They say they can cope, but it's very important. So they are going to have to cope in some way. It's likely to mean higher prices to consumers. Now, if you're a brick-and-mortar retailer or a domestic US retailer in some way, this is actually very helpful because you're facing this 10% increase in tariffs from China, which I think is largely manageable. But if you do have to put your prices up, then that's going to be the fact that this de minimis rule is ending is actually going to be really helpful because you're going to face less competition from Shein and Temu. So think of the dollar stores. Dollar stores have lost a lot of business. Dollar stores largely dependent on Asia. A lot of that will be China. Yes. Although everyone's diversified, you're probably one area where you're going to have to put prices up. Your consumer probably isn't able to bear it that much. But if they haven't got the option to go into Shein or Temu, that's going to make life a lot easier.
And this is really interesting in a European context as well, Guy, because plenty of European retailers have complained about, brick and mortar retailers have complained about the ability of companies like Shein to get these small parcels in without those taxes.
So you have sent them point to point. You have to send them to a person, and that's always been the kind of the deal here, and that's allowed these companies to grow really, really strongly and get round effectively other taxes. Andrea, does this affect Shein more than Temu? Like, Temu feels like it's trying to be Amazon, and in some ways it can basically bring a whole load of stuff in, move it into its warehouses, and then effectively be like Amazon in terms of distribution from there. Whereas the point-to-point, business-to-person business feels like it's more of a Shein story. I wonder about the IPO then.
I think they're both. I think they're both trying to move away from the de minimis. They've sort of seen this coming for a long time. They're both trying to prepare. I think this does raise yet more questions about the Shein IPO. I mean, you know, there are loads of questions about the Shein IPO, but this was always one of the things that suddenly this could go, and you're going to have to adapt. And, you know, they are saying they are adapting, they're not dependent on it, but it will make life more difficult, on top of the questions around what do you actually buy when you buy Shein? You know, it's a network. What exactly are you buying shares in? The whole questions about the supply chain. This is just another layer of concern to investors on top of the Shein IPO. Yeah, we're
going to keep an eye on that one. That's certainly some London interest in that story as well. It's going to be interesting to see how Amazon reacts as well. Amazon had thought about doing something called Amazon Hall, which was going to be basically trying to replicate this model. Maybe that goes away as well. So some big changes in this space. Guys, thank you very much indeed. Andrea Felsted from Bloomberg Opinion, Matt Bloxham from Bloomberg Intelligence. Greatly appreciated. Coming up, European companies struggling to access proper funding for growth. Therefore, they're taking their listings to the other side of the Atlantic. That's today's Big Take story. It's next. This is Bloomberg.
This is the opening trader at 30 minutes into today's session. Seeing some marginal gains on the screen, and I do mean marginal. The DAX is the outperformer this morning, higher by 0.1%. Fairly flat on the Stoxx Europe 600, the CAC 40, even the FTSE 100. I feel like, Anna, it's quite easy for me to say nothing much to report here.
Yeah, when you've got, you look up and Stoxx 600 is 0.01% lower. I think that's a fair assumption. But we are waiting for the jobs report, so things could get exciting later. Let's also talk about what's happening in the global markets story in terms of listings. Time for your Bloomberg Big Take. UK payments firm Zilch is weighing listing in the United States instead of its hometown of London. That would put it in the growing ranks of European companies chasing higher valuations over in New York, attracted by its deep financial pools and arguably its ability to price certain sectors better than here in Europe, more experience in trading them. Joining us right now is Bloomberg's Jan-Patrick Barnett, who's been working on this big take story. So this has been a growing theme in Europe. Certainly we talk about it a lot in the UK. Jan-Patrick, talk us through the latest here from Europe on this particular theme.
Yeah, it's a big theme, and it's growing in terms of that it's affecting more and more companies, and not just those that are thinking about like listing shares for the first time, but we have an increasingly number of established and well-known companies in Europe that are moving their listings. A good example is Linde in Germany, a chemical producer at the heart of like the core industry of Germany, and moved its listing. You have examples like software giant SAP, who rose to a record last year. And instead of headlines being like, this is great, we have a tech giant, the headlines in the local media was like, okay, when is SAP going to move its listing? So arguably, this is becoming a little bit of an existential threat to European markets, because it just feels like that more and more companies, new ones and established ones, have the feeling you can't grow here, you don't have the access to capital, there's not enough flow, there's no fair valuation for your company, and they're better placed in the US, even if their core business is and was Europe. And that's kind of something that the European leaders need to think about if they don't want to risk that European markets become even more irrelevant as they are right now.
Yeah, certainly something that's kind of an overhang on so many of these markets. What is the cure to this, what feels like a chronic problem?
There are a couple of things, and the good news here is that it seems like that the decision makers have taken on the challenge on fixing some of the stuff. So the first one is like you need a bigger pool of liquidity. Like we have 30 primary exchanges in Europe, a dozen central clearing houses. There's way more than the streamlined process in the US. So you need to have that what's called a consolidated tape, so that people have a better idea where liquidity is, and that it makes it easier to trade stocks on a bigger scale. I mean, there's like silly stuff that you have companies like ASML, where the ADRs, which are listed in the US, are trading more volume every single day than their original shares in Europe. That absolutely makes no sense. Second part is like the people are working on making the bureaucracy a bit less for companies to list shares. So less paperwork, less challenges for that, so that it's easier to go into the exchange, maybe even a bit early in the process, and collect that money. And then like the hardest challenge, I guess, is like you need to change the sentiment, starting from people who are putting saving money into the stock market, that they change the perception that the stock market is not a casino, but like a source for wealth generation and savings for your retirement over the long term, and that they appreciate that, and that there are great companies in Europe, and that it's worth investing in Europe, and that you don't need just Apple and Amazon in your portfolio, but that there are opportunities in Europe as well. It's going to be very hard to change that sentiment, I guess, but we need to start now because the gap to the US is becoming ever wider, and some might even say it's already a little too late, but we will see. At least they are trying to make some changes.
That gap has closed since the beginning of this year, which is fascinating. JP, great story. Thank you very much indeed. My screen envy continues. OK, let's carry on with the conversation. European stocks are outperforming and have done so far this year. The valuation gap, though, as we've just been hearing, is substantial. Joining us around the table, Matteo Stibo, Managing Director at the Investment Strategy Group over at Goldman Sachs Private Wealth Management. Nice to see you.
Thanks for having me.
Europe is closing the gap at the beginning of this year. Should I read that, and I'd be interested to get your kind of client take on this, as a sign that the diversification trade is beginning? Or is this just another head fake from Europe?
So it's interesting because the number one question we have been getting from our clients is why shouldn't they allocate 100% of their public equities to the U.S.? Yep. Given the extent of outperformance that we have seen in U.S. equities over the past 16 years or so, they look at those numbers and they say, given the underlying strengths of the U.S. economy, why shouldn't I allocate 100% to the U.S.? And our view is that they shouldn't do that. They should have some international diversification because we don't expect U.S. equities to continue to outperform with the frequency or at the pace that we have seen over the past 16 years. So therefore, having some international diversification continues to make a lot of sense to us.
Well, some would argue that the exposure to the European indexes is largely a play on American consumer resilience. So how do you square that?
Yeah, that is interesting. So take Germany, for instance. The economy is clearly struggling. It has not grown at all over the past 2 years. And this year we're forecasting a quite subdued expansion again. But if you look at the DAX, it's one of the best performing markets over the past couple of years. And a key reason for that is really because only 19% of DAX revenues are generated in Germany itself. So it's a very international index, and therefore you can get exposure to more the global story in Europe compared with the S&P 500, where only 28% of the revenues are generated outside the U.S., for instance.
So, Matthias, so just for me in my simple brain this Friday morning, so U.S. preeminence remains a thing or not?
We truly believe in that. So,
so what's why diversify then, if that's the case?
No, absolutely. So first, we call appropriate diversification as the second pillar of our investment philosophy. So we truly believe in diversification. It has worked historically, and we think it will continue to do so. But if you just look at the discount at which these companies are trading relative to the U.S., it's near record highs. And you also have incredible companies that just happen to be listed outside the U.S., and we don't think that our clients should simply exclude them from their portfolios just because of that. So for all those reasons, we think having some international allocation continues to make sense, but having that overweight to the U.S. is what we recommend clients do.
The problem with diversification is that it's meant that you have underperformed. So yes, it's a good risk management tool, but in terms of the outperformance you've seen in the United States, you have underperformed if you've diversified. Does that come to an end? Yeah, so Matthias, a client's prepared to tolerate that underperformance versus US stocks or versus the Mag 7 because they accept that they get that a little bit of underperformance perhaps, but that protects them from maybe something worse happening.
Absolutely. So even though what we have seen historically is actually that when the U.S. equity market is down 15% or more, non-U.S. developed and emerging market equities are typically down even more. So typically on the downside, it doesn't provide that much of a hedge to the portfolio. But again, we do think there will be periods when we will see outperformance of non-U.S. markets. The start of this year is the perfect example of that, which is why we think having some of that diversification makes sense. But I should note, we recommend that clients allocate roughly 80% of their public equities to the U.S.
So I'm confused now. Are European stocks good risk management tools, good diversifiers? It seems like you're basically saying that if the US goes down 10, Europe will go down 15. That doesn't sound like a great risk management tool.
I know. But if you look at the correlation historically between US equities and non-US developed equities, for instance, it's about 80%. So it's not 100%. So there are diversification benefits there. And there are episodes in the past when US equities basically traded sideways and European stocks significantly outperformed. It's just very difficult to time that really well. So as a result, we believe having that diversification structurally makes sense. But again, the overweight should be in the U.S.
So that assumes that the economic cycle, the economic expansion, which we're kind of seeing, is not uniform across the world, as in that the United States may be growing, but the rest of the world can't, but then the rest of the world may be growing while the United States slows down. So I guess my question to you here, then, is to what extent can Europe grow if the United States remains steady?
Yeah, so in our central case forecast for this year, we're forecasting 1% growth for the euro area, with, again, Germany lagging behind and countries like Spain and Portugal outperforming. But the view is that to the extent that you have more export-oriented economies, in the case of Germany, they are really struggling with the downturn in the manufacturing sector, as well as their heavy reliance on both autos and China. And China has swung from being a key buyer of German goods to being a key competitor to Germany now. So that is really hurting the German economy. But to the extent that we can get changes, possibly under a new government in Germany, that could unleash more investment in the country, which is badly needed. And then when we look at Southern Europe, tourism has been a key driver of growth. The services sector continues to grow strongly, and they're benefiting from strong immigration. So that could also help the economy to grow.
Matthias, what do you... So we've talked a bit about how Europe, and Guy had a chart of this just a moment ago, and we talked to Jan Patrick. Europe has been closing the gap on US stocks in 2025, just a little bit, and I appreciate there's only a month. But it has been, and it's not always clear why. Is it to do with front-running some change in what happens in Ukraine because of the Trump administration? Do you have a sense of why Europe is doing well this year?
Yeah, we think it's a combination of cheap valuations, light investor positioning, and people trying to position for potentially positive surprises. We know that we as investors tend to focus more on what could go wrong, but of course there are many states of the world where things could go right. So to your point, European stocks could benefit from that.
Okay.
Matthias Devo, Managing Director in the Investment Strategy Group at Goldman Sachs Private Wealth Management, joining us around the table this morning. We thank you so much for your time. Coming up on the program, we're going to talk about one of the stocks that, speaking of outperformance, has really been outperforming this morning. Dankse Bank has launched a new share buyback program as their net income beats estimates. We'll be speaking exclusively to the CEO next, right here on the program. Stick with us. This is Bloomberg.
We are in a new era of value creation and very confident that it is our scale, diversification, and the impact of our transformation which will allow us to continue to increase profits and profitability into 25 and beyond.
We think that at 13.8 of a common equity tier 1 ratio, and with our outlook in terms of earnings and performance this year, we think we'll be in a comfortable place by the end of the year.
We've stepped up our dividend. We even introduced an interim dividend to be paid in September of this year. So from that point of view, we feel that everything is on track and our platforms are delivering.
Welcome back to the programme. Some of the European banking voices there that we've been speaking to here at Bloomberg, talking about payouts to investors. Let's carry on with that theme. Danske Bank, one of the biggest gainers on the Stoxx 600 today. Denmark's largest lender has launched a new buyback programme. Joining us now for an exclusive conversation, Danske Bank's CEO, Carsten Egeriis. Thank you very much for joining us, Carsten. Really nice to speak to you here on Bloomberg TV. And let's start with the payout ratio. Let's talk about the amount of money that you're going to give back to shareholders. You're talking about a payout ratio of 100%, which sounds like a lot of profits, all of them. Talk to us about the rationale for paying out quite so much money to shareholders.
Yeah, first of all, thanks for having me. Well, we come out with a strong set of results today. We see top line growth of 8%, stable costs, strong credit quality, and strong capital position. We've had a few years where we didn't pay out and distribute dividends, and today we were able to go out and follow through on the commitments that we've made to our investors when we set our new strategy back in June 2023, which was to pay out in year earnings, and that's what we do today, and I'm very pleased to be able to deliver that result.
And we see positive response in your shares today. I wonder where that leaves the M&A story for you, for the sector, Carsten. We've seen quite a big bank merger in Denmark recently. Do you expect more of that? And would you play a part in that? I mean, you're returning a lot of cash to shareholders. Are you still able to do M&A?
I think, first of all, comment on broader M&A activity. There is no question that M&A activity is picking up, I think, both in the Nordics and across Europe. I think it makes sense because the banks, the European banks, are in a better state. They're strongly capitalized. Profitability has improved significantly. Risk management, compliance has improved significantly over the years. I think regulation and so forth has stabilized more. And on the back of a requirement to invest more in technology, invest more in cyber, invest more in risk and compliance, seeing more M&A makes a lot of sense. From our perspective at Danske Bank, we have an inorganic strategy right now. We're in the first year of our what we call Forward 28 strategy plan, and we're executing on that. But we'll continue to look out if there are opportunities for us to grow inorganically as well, then we'll certainly look at the opportunities.
Carsten, it's Kriti in London. I want to just very briefly bring it right back to the payouts question. I know Anna mentioned this is still one that's quite the vote of confidence, but your buybacks were less than estimated. I know certainly made up for by the dividend story. Can you just walk us through the calculus of why dividends over buybacks at a time when so many of your peers are doing the opposite?
Yeah, look, I think it's an important question, and clearly we have a dividend policy of paying out 40 to 60%. We pay out at the top of that normalized dividend policy. And then the question really is, how do you distribute the remaining 40%? It's a question that we speak with our investors about, with our board about. I think when you're trading below book value, buying back shares probably makes more sense. We are now trading, and after today, above book value. And so there is a discussion around what's the best balance between buybacks and dividends. Clearly, there is timing differences between one and the other. And given where we trade today, we felt that on the back of feedback, again, from investors and discussions with the board, that this mix would be the right one.
Can I just follow up again, morning, Guy, on this issue of returns? Can I assume that 2025 returns are going to look like 2024 returns? Is 2024 the benchmark for 25 in terms of the returns that shareholders are going to get from the bank?
Yeah, so we print a 13.4% return on equity today, and we have a target in 2026 of 13% return on equity. This year, or the 2024 earnings, was particularly driven also by very favorable impairment numbers. So we had a net release of impairments. And of course, rates were higher in 24, now coming down. So we are expecting, you could say, out to 2026, a slight decrease in return on equity, but more or less stable. So again, from 13.4% today to a target of 13% towards 26. And then in terms of total shareholder return, we have clearly said to the market that given our strong capital position today, we do expect to be able to distribute 100% of in-year earnings.
Okay. In terms of the NII picture, these numbers look better than the market was anticipated. Are we overestimating the hit that we're going to see on NII as a result of rates coming down?
I think it's an interesting question because all banks have different ways to hedge their deposit portfolio, and therefore there's a different level of volatility depending on which banks you look at. I mean, we had a strong Q4 also in terms of actual business activity, lending activity. And that has supported NII. And then in addition to that, we have a deposit hedge, which softens the downside, if you will, on interest rates coming down on NII. And clearly the offset as well, which we're expecting as we go into 25 and 26, is that we do expect that as inflation comes down and rates come down, that lending volumes, lending credit demand will pick up both on personal customers, but also in our business customer segment.
Carsten, you talk about that demand and certainly working in your favor at the moment, but there are geopolitical risks on the horizon. A lot of folks are talking about, especially in the context of Denmark being the largest Danish bank there. Walk us through any potential tariff risk to some of the household income, some of the growth forecasts that you have. How are you thinking about that, not just in terms of the U.S. relationship with Denmark, but the U.S. relationship with the EU as a whole?
Yeah, and this is, of course, a question that's really on all of our minds and all of our customers and clients' minds, and we speak with them about it daily. I think if you step back fundamentally as we look into 25, we have a view that macro growth will look like 2 to 2.5% across the Nordic countries. So slightly higher than Europe average growth. And that growth is predominantly going to be driven by an expectation that we will see increased customer demand, increased customer spending on the back of very high savings across the Nordics, on the back of real wage growth, both last year and also an expectation of that this year. So consumer spending, consumer demand supporting higher than average growth across Europe. But also when I speak with customers and clients around the Nordics, they're fairly optimistic about 2025. That said, of course, clearly a lot of uncertainty around what will happen in terms of trade war. How will that impact Europe? How will that impact different sectors? And that nervousness, of course, does potentially put some damper towards investments and how many investments and how to go about thinking 25. But still, overall, I think cautiously optimistic and a constructive picture, I think, for 25.
Carsten, very quickly, you're saying that your growth picture and the growth in Denmark is off the backs of the Nordics and the Nordic growth picture, not necessarily talking about any sort of tariff impact on the broader EU. Am I understanding that correctly?
Yeah, I mean, clearly, look, we are small open economies. So if we do see European growth being impacted significantly from a trade war, that will, of course, impact the Nordics. I think it's very unlikely looking into 2025 that any tariffs will impact the growth picture that we're seeing right now. It's very unlikely that will hit so fast. And we should remember, again, that on the back of inflation coming down and interest rates coming down, there is pent-up demand and there is a opportunity and an upside for consumer spending supporting the economy. But having said that, of course, it is a risk if the trade wars if the tariffs hit us harder than what we currently expect. And that is very uncertain at this stage.
All right. Danske Bank CEO Carsten Agerius joining us this morning. We thank you so much, Guy.
That stock's up 7%. Saab is down by 4%. The company's CEO there saying that 2025 is going to be hard to predict. You understand why, given what is happening with the geopolitics. The Munich Security Conference is next week. Let's talk about what we can expect at that event and what is going to come out of it. Ollie Crook joins us now from Berlin.
Yeah, listen, Guy, let's just get through these Saab numbers really quickly because I thought they were pretty interesting, despite the fact that the stock is down about 4%. I mean, we talk organic sales growth of about 29% in the fourth quarter. Their backlog has hit yet another record of $16 billion, up 22%. And again, their sales outlook is still pretty positive, up 12 to 16%. But again, as you highlighted, I think this is worth mentioning that the CEO is saying that basically there's a lot of uncertainty on the outlook because they really don't know where that demand is going to go, if it's going to stay where it's going to be. And the other question for them is how are they going to deliver their record backlog? And this comes into the conversation that we're certainly going to be having next week at the Munich Security Conference is how do you get these defense companies to boost these kinds of volumes? This is going to be front and center. I mean, you look at the volume and you look at the revenues from Saab. I mean, they only pulled in about, close to $6 billion last year compared to, say, Lockheed Martin's closer to $70 billion. These are the sorts of things that the Europeans are contending with as they try to build out their military. And we should say that this is going to be probably one of the highest level meetings we've had yet with anybody from the Trump administration with the Europeans. We'll have J.D. Vance, we'll have Marco Rubio, and we'll have Keith Kellogg, who is really the architect and the shepherd of the relationship between the United States and trying to end the war in Ukraine and Russia. And the key thing that we're going to get next week, Guy, is going to get the unveiling of Trump's plan to European leaders, not publicly, but we're hoping to get some information on that. What does the Trump plan include? We hope to find out next week.
Going to be some great coverage coming from you, Ollie. Thank you very much indeed for bringing us that setup into that. We'll be speaking to Saab, as he says. The weekend is almost upon us. A Trump week feels like a long week. I feel like we need a weekend. They're going to be horse racing in Samoritz. Watch out for that one. That's always fun. For my weekend is the rugby. I guess England versus France.
Is that even on the list, guys?
It's not. It's on my list, okay, yes. Very clearly.
Why did we not put that on the weekend teaser?
Okay.
I don't know. I think you undersold the horse racing. It's horse racing on ice.
Yeah.
Yes.
You say that like it's a normal thing.
What could possibly go wrong? I mean, we have to focus on the Super Bowl, don't we, from the sort of business of sports perspective. 124 people watch it.
124 people?
Million.
I think you may be underplaying that.
$5.50, sorry, that's billion, ad revenue at stake. This is a big thing. For live TV, the streamers haven't quite got hold of this one just yet.
The Philadelphia Eagles are really big. The Kansas City Chiefs are really cunning. I think it's going to be quite a good game. I'm not going to stay up late and watch it, but I look forward to Monday morning to being able to see the highlights.
Kansas City Chiefs, you didn't make a Taylor Swift reference there.
Well, apparently she's driving more women to watch. So there you go. There's my serious point off a Taylor Swift reference.
Yeah. Anna rescuing you there.
They're all serious. Taylor Swift's points are all 9% serious.
9% increase in the number of women who watched the Super Bowl last year, and apparently that's all due to Taylor Swift. News you can use here at Bloomberg. 8:56 here in London. Stay with us. The business of sport continues. There'll be a special programme around the Super Bowl on the close. That's at 9 p.m. UK time. That is it for opening trade. We'll leave you with the pulse. Have a good weekend, everybody. This is Bloomberg.